Hello everyone and welcome to your Glassnode video report for week 13, 2023. So we're going to dive into a really interesting topic and actually one of my favorite topics in on-chain analytics, which is the price of Bitcoin time. So you may have heard the term coinday destruction or coindays destroyed in the journey. We often talk about realized profit and loss, and we're going to talk about profit taking in this particular session, but I actually want to explore this through the lens of coinday destruction, which is really a measure of expended time from the network. It's a really, really interesting concept. It is unique to on-chain analytics, but I want to link together a couple of things within the lens of profit taking. So what we're going to look at today is kind of connecting the dots between a couple of different topics. We're going to start with some observations about what's going on with the exchange flows. So most people are familiar with exchange balances and when you see net inflows and outflows. So generally speaking, if we're seeing coins flowing into an exchange, we can somewhat assume there's a bit of profit taking going on. We're then going to link that to our realized profit and loss. And realized profit is obviously coins that were acquired at a cheaper price and are now being sold at a more expensive price, thus realizing a profit. And obviously we can say, okay, this coin's flowing into an exchange and they're realizing a profit. But we can't really, we can stop there, but there's also a bit more detail. And the reason why this part of this story is quite interesting is because it kind of matters where people acquired their coins as to what's going on with the conviction. We use time quite a bit in coinday destruction. We use this a lot to measure conviction because when you see old money, people who acquired in the previous bear, they've been here for a long time, the long-term holders, when they start spending en masse, lots of coinday destruction, that shows that they believe, these experienced long-term hodlers believe that Bitcoin is getting expensive. Conversely, when we see very little coinday destruction, is telling us that those folks with old coins are actually not doing very much, and that's telling us something about their sentiment. So this is a fantastic tool. It takes a little bit to get your head around, but we're going to be exploring this because coinday destruction becomes increasingly important as the market starts to recover, and particularly around cycle tops, because it's telling us what are those long-term smart money investors doing. So as usual, if you have any questions or comments, please let me know in the section below. I personally think that lifespan and this concept of coinday destruction is massively underexplored. I certainly use it a lot in my personal analysis. So do let me know if there's anything that isn't quite clear, and we will build up as we go. But the idea of this session is to kind of stitch together a series of ideas that you may not have seen presented before. Let's get stuck into it. Okay, so as usual, we're going to start with our dashboard and we are going to look at the price chart at the moment because what we can see is that we continue to consolidate. Really, this week has been a week of consolidation. And given how much outperformance we've seen from Bitcoin over the course of really year to date, it makes sense for us to have a bit of a breather. So it is holding up here in this $28,000 to $26,000 realm. And it is consolidating after a fairly spectacular rally. And what we tend to see is that price expansion leads to a contraction or a consolidation, and we have had a second expansion. We are now in a phase of consolidation. And why this matters is that even though price is going sideways, there's obviously stuff happening all the time. People are sending coins and moving things around the network and taking profits, even though price is going sideways. So we're going to start, as I mentioned, with exchange balances. Now, one thing that's really important to note here, we are looking at the net transfer volume to and from exchanges. So what this means is if we have all of the deposits and we subtract all of the withdrawals, what is the net result? So what you can see here is that we're talking about 4,200 coins that have flowed on net into exchanges. Now, on a daily basis, there are 20, 30, 40, 50,000 BTC flowing in. But in this instance, that means that there was 45, 55. There was slightly less coins, but still a huge amount more than the net volume flowing out. So remember that net is actually looking at the end result of deposits minus withdrawals. So on net, there was an additional 4,000 on there, but there's a lot of coins flowing in and a lot of coins flowing out every single day. So the important note here is that we can see that as price consolidates, we're trading sideways in price, we had the largest net inflow. It really compares to the post-lunar sell-off, right? So that was a fairly significant sell-off. All the coins that flowed in during the all-time high and that first leg down in December and January, and then back here during the sell-off that we had in May 2021. So it's not as sustained as these periods, but it's also non-trivial. We can then break down who was actually sending those coins in. Now, as you'll know, we'll often use our short and our long-term holder cohorts. This is based on the probability of how likely those coins are to spend looking on chain. The red zone here is short-term holders. The blue is long-term holders. So you can probably see in terms of raw coin volume, the short-term holders are dominating. Now, short-term holders are essentially post-FTX buyers. So we are looking at people in the dark red here, by the way, is in profit. Note how there's a lot more in profit coins. Compare that to FTX. Most people were at a loss, this light red color. So what we're seeing here is that short-term holders in profit, people who recently acquired their coins and are taking some, after a pretty spectacular opener to the year, are taking some chips off the table. So if we kind of take all of this into account, we can see there's a very, very small amount of long-term holder spending, but it really isn't overly significant. It's kind of similar to what we see during most of the, just kind of day-to-day type action. It's a little bit of an uptick, but not a great deal. You can also see that the majority of it is actually in profit, but most of our spending right now is going on with our short-term holders. They are the ones that are driving this behavior. Generally speaking, by the way, note these big sustained periods of long-term holders. This is an important note. Older coins are the most active, or actually, I should say this the other way. Owners of older coins, the hodlers, the smart money, the experienced folks, they are the most active at two different locations. Bull market tops, when they're generally dominating the sell side pressure, you can see that their sell side is much higher. And remember, these coins are being revalued from $3,000, $4,000, $5,000 to $50,000, $60,000. And they're also active at bear market bottoms because they are the ones who ultimately establish the floor. So there's two types of environments where they're most active. Typically, bull markets is where you see them being the most in terms of the net inflows to exchanges. Now, in terms of the realized profit and loss, we can see we've got a little bit of realized profit. It's fairly small on the grand scheme of things, but probably a more important metric to actually zoom in on here is our realized profit momentum. I'm actually going to zoom this one right out. So when we're talking about realized profit, what we're looking at here is on all the coins that are spent on any particular day. Let's calculate from the time when that coin was acquired on chain to its current disposal price, what is the total profit? We're not accounting for any coins that were moved at a loss. We're only looking at the total amount of realized profit in USD terms. Now, there are three key traces here. We have the orange, which is the raw realized profit in the background. We've got the red monthly moving average, and then we've got our longer term blue moving average. So this one here is looking at the yearly. So we often use these momentum shift metrics because they show us when there's been a bit of a regime shift or a change in character. Now, what you can see is that 2019 was one of those initial regime shifts. And then we broke down back below the yearly, signaling that whilst this was a strong impulse, the profits that were taken were not sufficient to actually maintain a full bull market momentum. So we oscillated around for this was over a year, and then finally got that upwards momentum for our 2021 bull market. And obviously these are all highlighted in purple when these events take place. Now we are in the process of poking our head. The monthly is just getting above the yearly as we speak. So there are profits being taken. We've kind of seen this across many of our metrics so far, but that's actually not the key thing I want to capture here. This is certainly one metric that we can look at. The thing that I actually want to look at is I'm going to actually remove our monthly and the raw realized profit. And I just want to look at the yearly average for a second. So the reason why this is an interesting metric is as we were kind of working through and building up this newsletter, it actually struck me that I've seen this very pattern before in actually one of my personal favorite metrics. So this is obviously trending higher in a bull market because profits are being taken. It will trend lower in a bear because, well, first of all, there's less profits to take because the bear can be pretty nasty. But second of all, as the market declines, we move to a regime where people actually start to accumulate rather than spending their coins in a profit. Remember, the people who bought down here at these low prices, once we are, halfway, three quarters, all the way through the bear market, The people who are actually selling their coins from down here typically only happens towards capitulation style events. And even then, this really doesn't create any kind of uptick. It's there, but it's pretty insignificant. So what we're seeing is two things. In a bear market, confidence grows. Those smart money are actually not realizing their coins with a large profit. They're actually moving back into accumulation mode. That also means that coins are generally more dormant. There's less activity on chain, and therefore there's less coin day destruction, time destruction. Conversely, when you see an uptick, a strong uptrend in realized profits, well, where are these profits coming from? They're coming from coins acquired a long time ago at much cheaper prices. Coins that were revalued higher, the profits taken in the 2021 bull were probably largely accumulated during the 2018-19 bear market at much cheaper prices. So this uptick in realized profits actually looks very similar in shape to liveliness. So liveliness is a metric that's doing the same concept, but for coin day destruction or the time component. So when we see an uptrend in liveliness, this is telling us that we have lots of holding time. Coin time is being destroyed from the system. When we have downtrends in liveliness, it means that investors, generally speaking, prefer to hodl. They would rather accumulate coins, put them into cold storage, and gradually remove coins from the market. So let's look at our last market cycle. So what you can see is that these downtrends in liveliness correspond with downtrends in realized profit. People are choosing to hodl and hold their coins in cold storage, and there is less profit being taken at the same time. In a bull market, people are spending coins that are older and they also carry large realized profits. So you can see that realized profit and liveliness are actually very, very linked because it's the same entities who are realizing large profits and destroying large amounts of coin days. So I've used this term coin day many times. So really what a coin day is, if you acquire one BTC and you hold it for 1 day, it acquires 1 coin day. If you hold half a Bitcoin and you hold it for 2 days, that's 2 days times half a Bitcoin is also 1 coin day. Now, when you spend those coins, what's happening is we consider them to be destroyed. So when you're holding coins, you're essentially creating those coin days. It's accumulating and storing. It's like a holding time for every single coin. And then when it finally gets spent and sent into an exchange or changes hands, we consider those coin days destroyed. So think about it as a volume of holding time that is getting destroyed by the market. So what I'm going to do, I'm going to put this particular model. This is just our raw coin days destroyed metric, which is an input to many of these lifespan metrics. I'm going to put it on a 14-day EMA. Actually, I might do a 30-day just to really make it nice and clean and clear. For metrics like this, because it's like a volume metric, I like to use exponential moving averages. Just makes it that little bit faster. Now, what stands out immediately clear is our 2017 bull market. Look, this is an uptrend, an increase in coins that are older, smart money, people who bought in cheaper, older prices are now liquidating into the bull. And note that it continues to trend. Look how quickly coin day destruction drops off after the top. Like many on-chain activity metrics, these significant drop-offs in coin days typically signify when active addresses fall, transaction counts fall, active entities fall, coin day destruction falls, we have probably just transitioned into a bear market. Great indicator for something like that. Note here again, 2017, that January peak was our on-chain high, and then we get a collapse. Now, there's a couple of other moments that coin day destruction ticks higher. Here's FTX. Here's Three Arrows Capital and Luna blowing up. Here is the final capitulation event here in November 2018. These capitulation events scare even the longest term holders. So these large spikes are typically events. This here is a trend. Bull markets are a trend. 2021 bull market is a trend. These events are much more capitulation style behaviors. So think about it like the volume of time, holding time, that's being flushed out of the market. Now, this metric here, which you'll also find as a workbench preset under lifespan, is just a really nice way to visualize what we call binary coin days destroyed. So if we think about coin day destruction, we can see that there's periods where it's higher and periods where it's quite low. Typically, high periods signify a bull market. old coins acquired cheaply, realizing profits, which eventually puts a top in. Likewise, during very quiet periods, there's not much coin day destruction. So let's take a long-term average, right, of all coin day destruction over the course of Bitcoin's history. Are we higher than or lower than the average? Now, what this metric is going to do, it's going to light up red and dark orange when we're much higher than the average for a sustained period of time. So these are typical of bull market periods. 2013, huge amounts of coin day destruction consistently above the average for a long period of time. 2013 peaks, the 2012 peak, our 2017 bull market, and here is our 2021 bull market. So these periods are really, really good to find when you're actually getting a bit overheated. And what that overheated actually means is that the smart money with the very old coins is distributing at a very heavy volume. They're taking large profits. There's lots of coins coming back into circulation, and these are coins that have been long discounted by the market because they've been dormant for so long. So we're starting to kind of increase the liquid flowing supply, which eventually creates an oversupply, which puts the market top in. Now, naturally, we get periods of long extended quiet when those hodlers are accumulating. They're not spending old coins, they're actually acquiring young coins, putting them into cold storage for the next rally. And with this metric, you can also see FTX, we can see Three Arrows Capital, we can see Luna, we can see these capitulation events, and they do appear indeed as events, less so as long sustained trends. Now, a related metric to Coinday destruction is called dormancy. And we're going to look at this on a more relevant what's going on at the moment. Dormancy is the average age of all coins that are being spent. So higher values means that coins that are older are being spent. Lower values means coins that are quite young. The amount of churn that's going on are fairly young coins. Now you can see that post FTX, we had a large uptick in the average age, right? Coins jumped up to about 26 days old, and we have seen a significant and consistent pullback. So what this is telling us is that even though price is rallying, the average age of coins that are being spent are actually mostly fairly young. We're seeing a decline in the average age of coins being spent, not an increase. So this panic was long-term holders capitulating out, and we're now seeing that the majority of coins, like our exchange metric, where we saw most of them are short-term holders who recently bought, taking some chips off the table. This is the trading, the speculative, kind of the general liquidity that's moving around day to day. They bought low, they're selling high. This is essentially how these games work, but we're not yet seeing a shaking of the confidence of those longer term holders. So this is just a really nice tool to help bifurcate out the long-term holders, what are they doing, and what's going on with those shorter term. Is this kind of just day-to-day trade, which in this case, it certainly looks like it is. So the very last metric I want to close on kind of wraps a lot of these things together. This particular chart is called the value days destroyed multiple. You will also find this in Workbench under our lifespan category. This is actually a model that was developed by TXMC when he worked with us. What this is trying to do is bring that coin day destruction out into the price domain. So what it's doing, it's saying, well, every coin day that's destroyed, let's value that against the current spot price. And then what he's doing is comparing that spot, how much coin day value is being locked in by the market. So it's kind of bringing in that like profit and loss, but it's a bit of time and volume weighted. So it's a very interesting and elegant metric. But he's comparing the current to the yearly average. So the long story here is that you can see that these green zones very much aligns with when our binary coin day is destroyed is quite quiet. We're not seeing a great deal of coin day destruction. The market's pretty quiet, typically aligns with bear markets. Now we are in the process of breaking up into this yellow zone. This is kind of the neutral territory. It's where Bitcoin spends the majority of its time. It's kind of typical conditions. However, we do see this primarily during bull markets. We see the occasional poke up and then it actually gets flushed back down. So again, this is very early. We have not seen a full-scale recovery consistent across many metrics we've covered over recent weeks. But we are now leaving, for the first time in some time, this kind of long-term bear market floor. So we will have to see whether this actually sticks. But probably the most importantly, you can see these overheated periods. This is showing that not only do we have lots of coinday destruction being realized, but there's a huge amount of wealth that's being destroyed at the same time. Not destroyed, but transferred between old buyers to new buyers. And the reason why this is really important, at the bottom of the bear market, and if you're still here, I think you're a hodler. You made it, right? It's a pretty brutal 2022. But you've become a bit more experienced. You understand how Bitcoin works. You've been studying on-chain data. You understand how the market moves. You've got a better feel than somebody who's going to buy their first coin as we break all-time high. So those experienced hodlers, which, in my view, if you're watching this video, you've pretty much made that cut. Anybody who's still here, you understand a lot more about this market than most people. So what's going on when you see these large periods of coinday destruction is those very same people who understood to stick around during the bear market when the times were the worst and the price was down only and everything was grim, but the education and the learning and the experience tells them things are getting a little bit overheated. This is a fantastic metric to pair with the MVRV. And remember, there's an MVRV dashboard that sits there to help you find these overheated conditions. So what I hope is that you can see how realized profits is part of the picture, lifespan destruction is part of the picture, and then we have metrics like MVRV or reserve risk. And you can start putting a couple of these elements together and saying, okay, I've got large exchange inflows, I've got large amounts of profits being taken. It seems to be happening by the smart money, the hodlers, they're destroying lots of coin days, and we've got exchange inflows upticking. Suddenly we start getting a spread of things saying, this looks like a market top that we've seen in previous cycles. So hopefully that kind of introduces you to lifespan and how we can use that to really bolster our analysis across various other categories. So thank you as always for tuning in for that session. Hopefully you learned something a little bit new. Lifespan is particularly powerful as we move into a more constructive market. As you can see during bear markets, lifespan's a little bit boring. You see downtrends in Liveliness and coinday destruction's pretty light, and it kind of stays there for years, months. But as the market starts to warm back up and you start seeing the smart money, the hodlers, the experienced folks start spending their old long dormant coins, that's where it starts to really kick in. So understanding and learning about lifespan before the excitement is really what we're going to be exploring over, well, recent weeks, but we certainly like to look at lifespan on our end. And as things start to warm up a bit, we'll start looking at this a bit more. Hopefully you found that useful, and I will see you in the next one. Cheers.